Growth will slow from 3.5% last year to 3% this year and 2.9% next year, a 0.1 percentage point downgrade for 2024. This remains well below historical averages. Important divergences are appearing. The slowdown is more pronounced in advanced economies than in emerging markets and developing economies.
The impact of economic pressures continue to inhibit stronger economic growth. According to the International Monetary Fund, prospects for medium-term growth is minimal. It says medium-term growth prospects have weakened since the global financial crisis. The IMF says global growth remains resilient despite historic economic pressures.
The global economy continues to recover from the pandemic and Russia's invasion of Ukraine, showing remarkable resilience, yet growth remains slow and uneven. The global economy is limping along, not sprinting.
At the same time, the IMF is encouraged by the inflation trends, but says better results could be seen in the year 2025. However, while both underlying and headline inflation have decreased, they continue to remain high.
Headline inflation continues to decelerate. Core inflation, excluding food and energy prices, is also projected to decline, but more gradually. However, all in all, most countries are not expected to return to inflation target until 2025. Inflation remains uncomfortably high. Near-term inflation expectations have risen markedly above target. Bringing these expectations back down is critical to winning the battle against inflation.
On the other hand, the IMF says the sharp increase in the dispersion in commodity prices across regions, including critical minerals, could pose serious macroeconomic risks.
Commodity prices could become more volatile with increasing climate and geopolitical shocks. This would represent a serious risk to the disinflation strategy. Between June and September, oil prices have increased by about 27%. On the back of extended supply cuts from OPEC plus countries, before falling back more recently by about 8%.
The IMF says global growth prospects remain weak, especially for emerging market and developing economies. It says fiscal buffers have eroded in many countries with elevated debt levels, rising funding costs, slowing growth, and an increasing mismatch between the growing demands on the state and available fiscal resources. This leaves many countries more vulnerable to crises and demands a renewed focus on managing fiscal risks. Nothando Makutulela, SABC News, Johannesburg.